A few weeks ago, I read a Bloomberg article which made me spit coffee all over my laptop. It claimed that, quote, net zero needs more metals, but less extraction from the earth. This seemed like a rather odd combination, to say the least, and I'm joined today by James Cooper, whose mission it will be to restore basic truth to this debate with his edition of Fat Tail Daily. James, you start with explaining basic mineral scarcity. Take us through just how hard it has become to produce or mine a ton of metal.
Yeah, thanks, Nick. So it has become harder. One of the reasons for that is all the low surface deposits have mostly been found. So we have to go deeper, and we're also sort of having to tap into lower grade deposits. So as a former exploration geologist, I guess I've had a sort of front row seat to seeing how the sort of scarcity issue is playing out in commodities, and the difficulty in finding new deposits. So one of the problems is the traditional locations, say Australia, where we would expect to find gold. These established sort of provinces like the Eastern Goldfields in Western Australia have really been sort of trolled over many times by explorers. So it's either sort of using brownfield exploration techniques, which just means looking at potentially expanding existing resources, drilling close by, which is often very low grade, or just going deeper and deeper under existing mine workings. Of course, the other option is to look at more frontier locations, so go into some international locations, but that obviously comes with different risks, geopolitical risks, and lack of staffing, and just we've seen some issues in West Africa, in Central Africa, and also in South America, with some geopolitical issues there as well. So across the board, I think it is becoming more complex. Deposits are becoming harder to find, but there's also this sort of nationalisation, so more countries probably rightfully wanting to get a larger share of their mineral wealth, which is making it harder for international companies to establish a presence in those countries.
So what's the message for investors based on that? It seems to me that just because prices of commodities might go up doesn't necessarily mean that these mining companies are healthy, because it could reflect the fact that it's become more expensive and more difficult for them to produce the metals and the ores that they do.
Yeah, that's right. So we've seen that especially with gold, and that's what I wrote about in today's edition of Fat Tail Daily. Just the fact that we do have strong prices for gold, the underlying metal, but that's not being reflected necessarily by producers, or especially the junior mining stocks. So that's just the developers and explorers. So further down the chain, there's really this sort of underperformance. Quality stocks, so stocks with strong output, strong meeting those sort of guidance production figures, are doing well in this market. I think where the issues are is the explorers or the developers looking to tap into finance to build these future deposits. And I think their time will come. That gap, that valuation gap, will start to close as gold prices hold firm. But I think one of the big disappointments for sort of junior mining stock investors especially is that they look at the resource market, they focus on buying these more speculative stocks with the hope that they'll get these sort of big leveraged gains when metal prices go up. But that's not happening at all. In fact, it's the reverse. You would have been better off just holding gold bullion over the last couple of years versus holding these volatile, risky stocks. So I think when you think about what these junior mining companies actually do, and that is addressing these supply problems, they're the companies that have been charged with uncovering new deposits, or developing new deposits. So their time will come, and I think it does take a lot of patience for investors. And I think when the market does recognise that value, it could come really quickly.
What caused the setup in the gold market to be this way with these declining mineral grades and the scarcity that's happened and all of these issues? How did we get to that point in the gold market?
Yeah, so I think when you think about how long it takes to get to exploration, development, and production, you could be looking at anywhere from up to 20 years to go from that initial discovery to finally hitting maiden production. So this is a really slow-moving train wreck, I think, in terms of the sort of scarcity problems that are looming. So just going back with history. So back in the 1990s, this was a really rich era for gold discovery, even though it was a bit of a down cycle in the sector. It preceded the big commodity boom, which saw record prices for gold. So I'm just looking at some stats here. So between the period 1990 to 1999, there were a total of 183 significant gold deposits, and that contributed to about 1.6 million ounces. Then we go into the early 2000s commodity boom, and that dropped to 120 discoveries, despite a lot of investment in exploration. But then the last 10 years, which is the period sort of from 2010 to 2019, that was just 42 major discoveries. So around a 70% slump from 20 years prior. So that just shows you that the scarcity is real. It's not this sort of hyperbolic kind of made up thing. That the data is pointing towards a significant decline in new discoveries. And I've spoken in today's issue of Fat Tail Daily about gold, but it does extend across other commodities like copper and silver as well. So it is really important. This data was just put out recently by S&P Global Research, so it's relevant and it's also really up to date. I think it just underscores the sort of mineral scarcity, which is born from lack of exploration.
Is it lack of exploration in the sense of spending, or is it the fact that, as you said earlier on, the easy ones have been found, the high grade shallow deposits have been found, and now we're down to the more challenging ones? Because you can fix one, but you can't really fix the other one. I mean, technology has become better, obviously, and that's been a big part in mining. But it seems like this is a pretty crucial question, because if you were to say to me, look, even if they did something crazy with the exploration budget, quadrupled it or whatever it is, the return on investment that they would get on that is going to be dramatically lower than in the past. This would imply significantly higher gold prices in the future.
Yeah, no, that's a really good question. I should clarify what I said before. Now, exploration in gold is actually been really high in recent years. So I think in 2023 it reached about 7 billion worldwide. And that was only just below the figure from when gold hit its record highs in the last commodity boom, which was around 9 billion. So the rigs are spinning. They are looking for gold. There's a lot of activity in gold exploration. So I guess that adds to the concerns that we're not finding more deposits despite all that exploration expenditure. So I guess that there's another problem. But I guess drawing from my experience as a geologist, from what I've seen, with these big boom to bust cycles, you tend to lose a lot of experienced staff with each downturn. So that last downturn, which existed from about 2012 to 2019, was, according to some geologists, probably the most severe in their sort of 40 plus year career. So that really caused a lot of experience to leave the industry. And that's really really expanded this problem of trying to find new deposits while at the same time losing a lot of experience from the sector. I guess just another example, 10 years ago, if you were looking to become, say, a senior exploration geologist, you would need 10 to 15 years of experience. Today, that's down to about 3 to 5 years of experience, and that just shows you that the industry is desperate to find enough staff to fill these positions. And of course, someone that's just out of uni is not going to be able to lead discovery or draw on years of experience to find which targets to focus on. So it's all these challenges which are really building into this broad scarcity theme, which is affecting several commodities.
Yeah, if we learned anything useful at university, the world would be a very different place. What I like about your work is that personal touch, the human side. These very young geologists getting put in positions of high responsibility, and then people are surprised when they don't come up with the goods. It seems to me that distinction is really important, because if you're trying to choose between a gold miner and gold as an investor, the question is whether there is gold out there that's going to be, found and cheap to mine and high grade and all sorts of things. Are there any locations around the world that are comparatively unexplored that probably do have some good deposits that are opening up, or the political risk is going down, that you're looking at?
Yeah, absolutely. So there's still places, and as we touched on before, they do hold some risks. So you can never get the perfect formula. You're either looking at these low risk jurisdictions in Australia, which may have been trolled over several times with these brownfield deposits, or you could go to greenfield high risk areas. One of the exceptions is perhaps Canada. So this country is one of the few areas which has actually increased the rate of discovery over the last decade or so. And that's in large part because it's opened up new frontiers for exploration. So much of the northern provinces weren't heavily explored in previous decades, whereas over the last 10 years or so, areas like the Yukon Territory have really become a big hotbed for new discoveries. So we hold a couple of stocks in that area of Canada, as well as Australian stocks. So I think it's important to balance the risk of, say, jurisdiction versus how good that deposit could potentially be. So it's really tricky trying to find that balance. Risk comes in so many forms. If you just focus on Australia, that risk could be from low grade, low margin operations. If you're focusing on Africa, obviously that risk is political. So there's no silver bullet. You just have to manage the risk and find deposits which perhaps compensate you for that added risk.
I'm really starting to understand, based on this video, why you're focusing on takeover targets in your latest investment presentation for your subscribers. Seems to me that if you're going to buy a gold mining company, you're not just buying it for their current deposit, you're buying it on the presumption that they're going to find several more deposits and sort of exist indefinitely, which it sounds like is going to be unusually difficult to do. Whereas speculating on a company that has a more or less proven deposit that's likely to be a takeover target from a gold miner, an established gold miner, seems like a better way to go, to try and reap that reward, the short-term trade, rather than the punt on the long-term viability of mining gold in, say, Australia or wherever it might be. So tell us a bit about this presentation of yours, where you've identified these companies that are likely takeover targets. I think it's not just in the gold space, there's a couple of others as well.
Yeah, that's right. So we've focused mostly on copper and gold. There's also one other commodity in that report, which sort of, it's just this broad scarcity theme. Yeah, so as you say, a big focus for our paid readership group at Diggers and Drillers is looking at deposits which are undeveloped, preferably large. So this, I think, will be the sort of the sweet spot in the market in the years ahead. That's because you've got with these junior mining stocks, which are heavily undervalued relative to metal prices, you can be a bit more selective. So there's no point really getting an explorer which doesn't hold any known resource when you can get a junior which has a large untapped resource already sitting in the ground at a steep discount in the market. So that's really where our focus is. I think that's where capital will tend to flow first once it trickles down from the producers. It's looking at these large deposits which will help sort of fill the shortfall once these established miners start to sort of deplete their assets and look for replacement reserves. So I guess that's where the sort of merger and acquisition opportunity filters through, is that these big companies will be looking for smaller companies holding known deposits. And I think that's where the opportunity is.
All right, James Cooper, thanks for all of that. Don't forget, everyone at home, to check out James's original article on the Fat Tail Daily website. You can subscribe for free if you enjoy it, and make sure you check out tomorrow's video in Fat Tail Daily as well. Thanks very much for joining us. Before you go, I have another announcement. Our publisher Woody has promised me a $10 million bonus if I can double the number of subscribers to Fat Tail Investment Research's YouTube channel. So please like, share, subscribe, and send this video to all of your family and friends. Let's give Woody a nasty surprise when he comes back on the 23rd of September.